It was time for a video on investing in stocks and shares, and I really want to go through the sort of process I use in picking some stocks and shares out and identifying companies I think might be winners in the longer term. So there's a few important steps here, and I think one of the most important ones is invest in what you know. Now on the screen in front of me I've got a list of companies here. The symbol here is called a ticker symbol. It's the abbreviation, some of them the full name, like Avon Rubber Industries, and that it's an abbreviation for just the name of the company. The next row is the current share price. I've got a 10-year high, 3-year low, the change in the daily figures, 7 days and a 4-week basis. But this is quite an extensive list of companies. This is a UK listing, and I've got probably just over 100 or so companies on here, but they're all companies I've heard of. It doesn't mean I've got shareholdings in every single one. They're just companies on the list that I've got some knowledge and understanding of, and I tend to keep an eye on. Really, in investing terms, do you need 100 or 1,000 companies to invest in? No, some people do invest in big group funds, which are big groups of companies, or baskets of companies, if you like, or they invest in a whole general market, or which could be the American S&P 500 market, or the FTSE 100, or the Asian markets, etc. So I've tried to try and pick out maybe that dozen or so companies that I think in the longer term they really can perform for me, and trying to find the best of the dozen's a bit tricky. So it does take a little bit of work. So investing what you know is really quite important, because if you haven't no understanding of the industry you're investing in, and what's happening in their marketplace and what they're all about as a company, you really are probably taking a bit of pot luck, really, if you're trying to just stock pick. So also to be aware of the bigger picture. The bigger picture means like the macro environment is probably the technical word for it, but it's what's going on in the world. So at the moment, maybe we're looking at inflation, we're looking at the Ukraine situation, and all sorts of other factors that are going on. But it's looking at that picture of what's in the news and what's happening, and then thinking about companies you may be looking at investing in that are on your watch list, to be thinking, what is the impact going to be on those businesses on an individual basis? Some of them will provide very short-term opportunities in the news, and other ones may give a bit of a longer term picture that you just need to be aware of as that big picture. Golden rule number 3: fools rush in. Patience really is a virtue in this. It's very easy to think, well, I've got some money I want to invest, and who do I put it in? And I want to put it in there tomorrow, and that's not necessarily the best way to go, because it may not be the best time to invest in that business. Mind you, picking the best time is really the tricky bit. So it is nice to keep an eye on a company that you understand over a period of time, know what's going on, understand it thoroughly, and have done your thorough research on it before investing your hard-earned money. So there's a variety of ways of doing that. There are stock scanners out there. There's a whole variety of websites out there that will help you finding companies that may be on sale, or going at the right sort of price at the right time. So there's a whole way of doing it. So I use SharePad quite a lot. I also use Simply Wall Street. So I'll give you a quick overview of the two. SharePad is probably one of my favourites, because it's been a nice way of building up a watch list of companies. That's a UK one. If I click up on the portfolio button, we can go into the whole watch list, which includes some American ones as well. So Google and Amazon, etc., Tesla, all big companies you will have heard of. So it doesn't matter which way you do it. Let's go back into the UK watch list. So for the chart button here, if I put this up onto the full screen for all the text versions, so we've explained some of these. PE is price to earnings ratio. Typically, if you've got something that's sort of around the 15 mark, you're about ballpark for what it possibly should be in the market. If the price to earnings is below that figure, it probably means the company might well be on sale. If the price to earnings figure is very high, it may well mean it's a growth company and people are betting on its long-term potential as a business. or it's just fundamentally grossly overpriced. So there are some companies out there that have been very high growth stocks in the last few years, and people are betting on what's it going to be 5-10 years time, and they're pricing it way into the future. And there's companies that may be priced extremely low, which is the other pitfall, where they may be on the verge of bankruptcy. So, for example, Cineworld there have gone Chapter 11 bankruptcy in the States, but in the UK they're continuing trading, but the share price is extremely low compared to where they have been. So there's various factors into it. So it's not a be all and end all with a PE ratio. But the nice thing on something like SharePad is you can sort them. So hit the button there, hit sort, and it'll rearrange the companies to who's the highest PE ratio. Hit the sort button again, and it'll bring you who's sitting up on the lowest PE ratio. So the other ones I keep an eye on can be debt to free cash flow. Free cash flow is a very important figure. It's that the amount of free cash that's left in the company at the end of their trading once they paid for everything. And free cash flow is that very important thing that if they have no free cash flow or it's in a minus and it's getting worse, it can be a bit of a warning sign on the business. ROCE is return on capital invested. Again, this one allows you to sort through companies as an initial sorting to see who's giving a really good return on their capital. Now, again, that is going to vary from industry to industry. So for companies like, say, Moon, which is Moonpig, which is very much just an internet-based business selling greeting cards, it's very much just a website business. So they don't necessarily have massive amounts of assets. So their return on capital is quite good because they haven't got the massive outlay in asset. So if you then sort that, we'll pick someone with a very low return or something that's more mediocre. We've got something like, let's go, Costain's probably not too bad. So they've got a lot of other overheads going on in terms of the business generally. And so the amount of capital they've got to invest to get a return is going to be dramatically higher. So it will vary from industry to industry. So there's a lot of other little factors there to bear in mind with that. So nothing's quite as straightforward as you really think it's going to be. And there are a number of other little things that's coming up here and some what the broken consensuses are, etc. So you're getting a wider picture of opinions. Now, if we mix that into the graph as well, if you watch some of my other videos, you'll see these graphs appearing. The nice thing of this is you can scan from a daily basis on the graph right up to 10 years and plus in terms of what the company is doing. So I tend to like probably a value investor looking a bit longer term. I like to look at 3 years, 5 years, 10 years, when we're getting a bit of a back history and maybe picking out maybe where some of the low share prices were and identifying why. Whereas if you're day trading, which is extremely risky, you're looking on a day-to-day basis on the share, and some shares can be extremely volatile in their pricing, and that's where some people are making money, almost gambling, I would say, on the ups and downs of the market. So this is fundamental analysis, whereas the day-to-day ones is called technical analysis. The other nice thing within the SharePad thing, it gives you a lot of the financials there on the company. It can give you a summary of the business in terms of its little ratios, which can be a bit more complicated, and I won't deal with them in this video. It'll talk about the company generally, where they're trading in the world, what they actually do, and the board directors there as well. Okay, it will also give the income statement, balance sheet, and the cash flow statements. Now I tend to use, for my things which we'll come to later, I tend to use Yahoo Finance, although it's all a bit back to front. You have to do it manually and to put the figures all in. I find it a bit easier than this one, but this one, SharePad, does give some nice things as well, which I will tend to use EV to EBITDA ratios as well in comparisons. It will also tell you the dividends that the company is paying out, if they are paying out any dividend. There's some forecasts from what other analysts are looking at in the market. So there's a lot of other information on the companies there that are quite useful. Now, level 1 and level 2. I've got level 2 on SharePad. You pay a higher monthly premium for it because it's giving you to the moment share pricing. Now, a lot of people who are maybe long-term investing, you don't need to know what the share price is doing every second. So a level 1 setting is fine, and that will give you a 15-minute delay on the pricing. But it's for 15 minutes in the next 10 years. Sometimes it doesn't necessarily really matter. A nice function I do use is this is the investor tools as well, in that it'll give you with free cash flow, you can put in a yield percentage that you're looking for, and it'll then give you the buying price there. So that's set to say a 10% yield. That's giving you a target price of minus 60 pence in this particular case. So probably Costain wasn't the best example on this one. So I picked out Sainsbury's there as an example. Current share price 243, and on the 10% yield, you'd be looking to buy at 203 or under. You can adjust that to a 15% yield there, and it'll adjust the figures and give you a price of 135. Not that Sainsbury's been down to that figure for a very, very long time. The other format site that many investors find very useful is Simply Wall Street. It gives a lot of very elliptical shapes for things, and I think when you work out there, as they call them, snowflake patterns, it can produce some quite interesting information. I think with Simply Wall Street, it's an Australian-based company, so it doesn't mean they necessarily have a 100% understanding of UK companies or some of the American ones as well. So they compare businesses to other businesses, but then may not be the best comparisons in the world. But they do give an awful lot of other information in there. So what's interesting with Simply Wall Street is they will give you on the homepage, if you've got a watch list of companies, they'll give you some of the news that's coming up on them, or has been in the news recently. So it can be quite nice for another source of updates there. And this works on an annual subscription basis. They also do, within their shares, have an interesting free cash flow model calculator, which tend to take with a little bit of a pinch of salt, but sometimes it could be an indication when you've got a company that may be a growth company and a simple measure isn't going to work because the cash flow is negative. So really, when we're looking at the company, so we're looking at the directors and their background, it's very important that, because some directors are better than others, and if you find someone who's got a really good reputation in their industry, it can really make them well worth investing in. That's probably why those guys can be paid an awful lot of money, and girls. Looking at the long-term opportunity for a company. So I'm not necessarily investing, for what next week or next month. It can be something a lot further ahead. Are you a dividend investor, a value or a growth investor? So dividend investor is looking for companies that pay out a regular amount of money to the shareholders as a thank you a couple of times a year. A value investor is investing. They can be more companies that are they're quite big, they're quite steady, and they're growing at a steady rate, and they're quite reliable going forward. And growth companies tend to be companies that they may be making a loss, but they're growing at a phenomenal rate, so they're likely to be very profitable within the next couple of years. Now, some of them tend to go the other way as well, so it can be a bit more speculative. I think probably the biggest example of that in recent years obviously has been Tesla, with a growth opportunity that's been absolutely enormous, but then that can be reflected in the PE ratio and the pricing of the shares as well. So this is a little look at Yahoo Finance. I tend to use the Yahoo Finance app on my on my phone quite a lot as well, and that's quite handy as well, because you can put in little stars on companies when they're on the watch list, when they're hitting a price target you put in there, and it'll flash up on your phone. You can put price alerts also in SharePad as well. Let's go back to the alarm section just quickly on that before I go back to that one. So if I go to alarms on a price, you can set pricing in, and it'll come up in a nice little pop-up box here if it does hit the target pricing you're actually looking for in a company. And you can set all sorts of factors to come up. You can tick it if you want news stories that are coming up on the business. And the news story back here in SharePad, it will give you daily news on companies within your watch list of what's happening. A lot of them will just be share transactions of the company buying back their own shares and things like that. But some of them, when they tend to highlight them, can be bigger news of something going on in the company. And they tend to be highlighted up in the red there. So I tend to log in every morning and have a look through this and see what's going on. If there's something happening that can be really a day ahead of where the newspapers are, because it's at the moment. So back to Yahoo Finance. The front page here is giving you a summary on the business with the PE ratio and some of the other ratios in there, which we'll come to a little later, and some nice nice charting as well, which will cover from a daily basis, and you can tick in just like the SharePad one's a cheaper version, I suppose. You can type in a monthly figure, 5-year figures, and the maximum they've got for the company to see how they're performing. So the thing that I tend to use in the mobile app version is the financials. So they'll kind of have a TTM, which is trailing 12 months. They'll have they have annual financial report figures, and they'll go back for about 3 or 4 years or so. The annoying thing is, because it's going backwards this way, when I put it into the Excel graphs, as we'll get to in a little while, I have to then turn all the figures around. So it's a bit of a laborious process, but it does work. But it does give a lot of the information you're going to need from the income statement, the balance sheet, which is the pluses and minuses, the current assets, and the liabilities of the business, and the cash flow. So in cash flow, I tend to be scrolling down to the bottom here, because the bits I'm interested in are going to be the operating cash flow, capital expenditure, and that figure there, the free cash flow, is the important one, which we'll do the sums with, which come to in a little while. There's no reason why you can't do your own spreadsheets in Excel or in the Google equivalent as an online version, which is free. Now, Microsoft Excel, if you go for the 365 version, which is a subscription model, it does give you the opportunity to put in share prices and refresh the data, and it will then update all the share prices and the other ratios and bits and pieces that you've put in, which you can build in as a standard. Whereas if you buy just an off-the-shelf version, it won't do that, and you have to then go through it and do it manually. And if you end up with a lot of companies on your list, that could take a very long time. So it's a nice time-saving thing for, I think, about £10 a month. So on here, this is all done as a formulation. So the ticker symbol is there, hidden by that. So you just convert that to the stocks and shares naming that it's got. That one will be like C4 dot ticker symbol, C4 dot price. It'll give you the share price. It will also calculate the change there for you. It'll give you the 52-week high. It'll give you you can then tap in the other figures yourself if you want to do some of those. And it'll also give you PE ratio and a whole variety of other functions for when you go and change that figure as a lookup. So if you've seen some of my videos, this will look a little bit familiar. You probably only see the scaled down version in my videos, because I tend to run through the different graphs because I've put all the sums together. But we're going to run through some of the nitty gritty of it. And this may be something that you want to watch over a few times to make a few notes and build your own versions of it. So I've got Catebox on here as just an example one, because it comes up with a nice pretty graph. So what I've done is taken the Yahoo figures and working the other way to Yahoo. So you've got to do it manually to tap them all in to put in the turnover. I work out a revenue growth rate, the gross profit, interest expense, which we come to a little later, income tax expense we come to a little later, and the tax before, or the income before tax, and the net income, and work those figures down. So I've got earnings per share. So that's from the income statement. From the balance sheet, we've got the current assets and the liabilities there as well. And then there's the cash flow statement. So operating cash flow, capital expenditure, and free cash flow is really the important ones. So I then come down to a summary section. Now this is quite handy for linking it into some of the calculator parts, so you don't have to manually input everything there. So once it's set up, away you go. So that's then copying the some of the data from the current figures above, and some of the yellow boxes there is where I have to just input some extra bits and pieces. So total cash and securities is within the balance sheet, and those debt figures there are within the balance sheet, but they're going to be used for a sum I'll come to very shortly. The share price, the bond yield rate for a 10-year bond. Yahoo Beta is on the it's a ratio. It's on the on the homepage of each share. You'll see that in summary as a ratio. If there isn't one there, I just tend to put in 1 on that. And to get the calculator to work for some of the other calculators we'll see in a moment, for the discounted cash flow calculator, some of the other figures from above are then re-recorded. I tend to put in the date of when I've last done something on that site. Well, I've input some information into it, so I know where I am and know where the financial year is on the company. This part here you'll have seen in the calculations, Phil Town's 10-cap method. This is, if that figure is over 10%, it's well worth looking a lot further. So the formula for that is, if you've seen some of my videos, get that to clear, is operating cash flow minus half the capital expenditure divided by the market cap. So it will then look like a formula like this. So I've got those figures sitting within this column here somewhere. And so we're taking the cash flow minus half of the capital expenditure and then dividing that by the market cap. And then that'll give a percentage. 10% is where we're wanting to aim above if we possibly can. And that then will indicate there's a little formula for that. The formula is if stroke, we can see it up in the box there. So if you zoom up your screen, you'll be able to see that. If one is greater than the other, comma, buy, comma, sell. And that will then put the nice words in the box for you. So let's take a look at the graphs. What I have done is then use other blocks of figures which are copies of the ones we've input a little earlier. So they relate to the different cells across from where they were, N6, O, P, Q, R, S, T, U, V, etc. So, and you can then graph those out to create the graphs that are sitting below. And that's done for the free cash flow one, for the capital expenditure, for assets and liabilities. What this does do is if you take that bit of time to actually go through Yahoo Finance and put the information in there, you do get a graphical representation of the numbers, which is so much easier to read. And the reason I like the cake box one is because everything's kind of going up, and that's kind of like an ideal you're looking for. Not a reason to go buying or whatever at the present time, but it's just a pretty graph. So that's the turnover, gross profit and net profit. We've then got assets and liabilities. So you can see what level of debt they're running at compared to what the assets are actually doing. If that debt level is very high, that can be quite a warning sign on a company, because when interest rates go high, as they are at the present time, that can be really quite damaging to a business. Capital expenditure, again, how much money are they're throwing around and having to reinvest on a regular basis into the business. And the free cash flow, that important one, that's the money that's kind of left over after everything, and how you kind of work out what a business is actually worth. So let's go across to that side. So this is the discounted cash flow. Now, to think I came up with this myself? No way. So the credit for this is going to go to Novus Investing. There is a YouTube video on this out there. I'll see if I can put a link in the description below for you to have a look at and work through that one, because he does talk through it in a lovely way. And I've tried different models of this over the years, and this has come at such a nice, simple thing to use. So we tend to work out a growth rate. Now, the growth rate I tend to take from, as Nova suggested, from the Yahoo Finance site. So if we nip across back to that, and go across to analysis, tick the box there, scroll down on that one, and right at the bottom it gives a 5-year growth figure. And so this is like an analyst's consensus that they think the business is going to grow at 8.6% per annum. So we can change the figure in there, 8.6. Now, the perpetual growth rate is 2.5%. That's kind of a fixed figure that sort of stays forever. The discount rate is the weighted average cost of capital, which is a bit of a mouthful, really. Now, that's done some of those sums I was mentioning earlier, where we were taking the interest expense and the income tax expense, etc., needing to know those figures. Because this works out a calculation of what is the capital actually costing the business. The risk-free rate is the 10-year bond yield rate, which obviously the UK rate is different to the American one. There's that Yahoo beta figure. Market return 8.5%, which is fixed, and then it wheels through the little sums in the calculator and comes out with 9.17%. So that's then linked up into the discount cash flow model there. Now 9.1% is the truest version of the figures. Now if you're doing like the Phil Town thing, and you want to say, well, actually I want a 15% return on the business, then you tap in 15, and it then just recalculates all the figures for you. So the discounted cash flow, the model only works if the free cash flow is positive. If the cash flow is negative, the sums aren't going to work. So you'd have to come up with something else for that. So this then, with free cash flow, it extends the free cash flow and projects it forward at the growth rate over the next sort of 5 years or so, and then works it all backwards again, taking off the weighted average cost of capital or the discount rate that you're looking to apply. So it then helps to calculate with the cash and marketable securities that we had over in the other box, and the total debt, so the short-term debt and the long-term debt added together to come up with an equity value. You then divide that by the shares outstanding, and that will then give you a target price per share. Ideally, you're looking to wanting to buy that company with a 50% discount on that target price. Sometimes that can be maybe a little bit unrealistic. So it's not a set in stone or such an easy 100% tangible thing, because there's so many factors in buying a company. So it can come down to, although you're trying to cut the emotion out of it, some of the emotion is there, and you're saying, yeah, well, there's other factors that are outside which you've looked at as a business, but this is kind of the check that says, well, where did we work out that price that we really want to try and be looking to buy the company at? So it's projecting a figure. You'd really love to buy the company at 61 pence, and yeah, that may not be happening. So you've got to maybe be a bit more realistic, but it's certainly going to give an indication there. There's also the Simply Wall Street model pricing to compare it to as another option, because sometimes this figure will come out either extremely low or negative or a lot higher. So there's several things to put together. It's not so simple. This is the Graham intrinsic value calculator from Benjamin Graham's calculators. As there's several of them. This is working on the EPS value, the earnings per share value, and works out with some of the other sums to come out with other equations. There's a whole variety of ways of doing this to try and come out with a figure. That's why all the figures tend to vary. But at least to try and get some sort of indication. And often what I do, if you've seen many of my other videos, is also go back into SharePad. Let's have a look at the chart over several years. And identify the high points and the low points in there. See where our free cash flow value was and what the DCF value was. And anything below that figure ideally is where you want to be buying. Not necessarily going in one go, but the general guidance is to buy in blocks. If you buy, I'm at a good target price, I like the price, it's going to show me a good return, then that's a good starting point. If the price goes lower, you can buy some more. If it goes lower again, you can buy some more. And hopefully the chances of hitting the bottom are extremely low. But that's all part of the game. So you don't actually want to try and sit and wait forever for the low point, because you may well miss what was the low point and it's turned back up again. So yeah, it's not an exact science. So hopefully that gives you a very good overview of how I look at identifying companies to invest in, and that longer process involved in identifying maybe when you want to go investing into them. So good luck with your investing there. Look forward to seeing your comments in the comment section below. Today's video is sponsored by Rule Number 1 by Phil Town. It's a lovely, easy read, and one of the first books I read getting involved in investing. It shows some lovely, easy ways to calculate the true value of a business and work out what sort of price you'd be looking at to buy a business when it's on sale as the ideal time. So you can click on the Amazon link in the description below, and for $8.99 you can get some great easy reading as a good way to get started in investing. And clicking on the link also helps support the channel, of course. So if you like the videos, do like, comment and subscribe, and we'll catch up with you again soon.